Canadian economy has fallen into a technical recession, but will slowing economic growth be enough to get the Bank of Canada off the sidelines with some interest rate action? Joining us now to discuss is Derek Burleton, Deputy Chief Economist with TD Bank Group. Derek, great to have you back on the program.
Thank you. Good to be here.
All right, people are picking up newspapers, they're picking up their phones, they're seeing the headline that Canada is in a technical recession, and then they're hearing that perhaps there's some nuance to that. Let's talk about the health of the economy beyond the headline and what's actually happening.
Yeah, I mean, it's weak. We had the GDP data for the first quarter last week, and if you squinted your eyes, you'd see a very small negative in the quarter. That meant two straight quarters of declining activity. We had minus 1% in the fourth quarter. Hence, as soon as I saw that, I said, okay, this is going to lead to a lot of headlines about a so-called two-quarter-in-a-row technical recession. Economists look at it very differently. I think our bar on what is considered a recession or not a recession is definitely higher. You need more conditions to be met than just two straight quarters, particularly when the declines are very shallow, like the minus 0.1% annualized, which could be revised away. So I think the way I look at it is the economy, when we went into the early part of this year, the first quarter, we knew it was going to be a tough environment for growth. We had something like 1% growth forecast for this year, which is not a big growth cushion. It wouldn't take a lot to go wrong to kind of tip it closer to stagnation, maybe even a mild recession. And in fact, we're in that kind of camp of stagnation right now, maybe mild recession. It's too early to tell. But you think about the forces on the economy. We've got declining population. We've got trade uncertainty. We've got weak housing market activity. It's just the perfect storm. And as a result, we're seeing that show up in the data. The one thing, Greg, I would point out is, and we get the updated job numbers later this week, is I'll be looking at the unemployment rate because that's been quite stable. I think if that were to continue to trend up, if we get something into the low sevens, it's 6.9% right now. It's been fairly flat on a trend basis. If that starts to rise, then I think it's just going to inflame all this talk that we're heading into a recession that would follow.
What could get us out of this stagnation? What do we need to see for this country to start moving in the other direction?
Well, and I think some of it's just short-term data volatility. Some of the factors that weighed on the economy in the first quarter, I don't think are kind of sustained in the second. The first thing is government spending. We saw quite a significant disappointment in terms of relative to our expectation of government spending. I don't think will be repeating itself in the second quarter. Some of the disappointments in areas like non-residential investment, some of the projects we're hearing about, that I don't think will be sustained. So our early read on the second quarter's return to 1.5% positive growth. That should end the run. But it still is a weak economy. You get a bit of a bounce back. And, I think we're looking at next year at the earliest. I think what we need to see is some of the uncertainty around tariffs hopefully lifting a bit. Some of just the uncertainty around inflation, the energy shock to lift a bit in some of the oil-consuming provinces like Ontario, Quebec. And I do think next year we'll see a little bit better turnout.
Is it, in a sense, too, we talk about longer timelines. I'm thinking back to the last federal budget, and it was supposed to be a big growth budget for the country, but it wasn't going to be the kind of growth that was going to happen instantaneously. What's the timeline on actually starting to see some fruit from that? Yeah, we are seeing. In terms of the projects underway, we've got the project office federally. They've got about $110 billion in projects that have been identified, and we're seeing about 15 projects. About 4 of those are moving ahead, maybe a 5th one later this year. So to your point, it's not so you don't flip a switch. It takes time. That, I think, is part of the medium-term forecast. And even then, we don't include a project till we're very clear on timing and amount. And a lot of these projects are still too vague, like the pipeline. But I think it's the other areas of spending the government does have, and what should help the economy in the short run. The new groceries benefit kicks in this month. That should provide a little bit of a short-term lift. That's government spending transfer to and then you got the World Cup. Now, nobody's thinking this is going to lead to a big permanent shift in the economy, but at the margin, could help lift growth, particularly through the tourism sector in the summer, into the fall, some of the ripple. So you have some of these other factors I think will help at least keep the economy, its head a little bit above water. Which is where we thought we'd see the economy. I think it's really just been a disappointment in the first quarter. We didn't see growth. Now, for that disappointment, what does the Bank of Canada do with those kind of numbers? Does it start to change their mind about what their rate policy should look like?
Well, what it won't do, or what it shouldn't do, is raise rates. And I know the markets have been on that. You've got a number of forecasts saying, we're looking at a string of rate hikes. And at one point, the market had priced in 3 rate hikes by the end of this year. Now that's been dialed back to 1 hike. I still think that's a bit rich. We have a no change view, and I think that's probably the best baseline guess at this stage. And if you were to pin me, if the economy we don't see a bit of a lift in the second quarter into the third quarter, again, not great growth, but just strong enough, then they could be cutting rates. I wouldn't be surprised if some of the focus shifts towards, and it'll depend a lot, obviously, on oil prices and what's going on in the Middle East. But if we do get a bit of a waning in oil prices, you get the economy that's still quite soft, I wouldn't rule out the Bank of Canada at some point entertaining rate cuts. It's just we're not there yet. The bar is still high, either in hikes or cuts at this stage.
You mentioned oil. Is that still a wild card for this economy, whether it's going to help things or hamper things? And I guess then we start talking about different regions.
It is, and we're parsing the data to see, because you're right, there's very much a have or have not when it comes to high oil prices, higher commodity prices. We have to remember other prices are being affected in aluminum and some of the minerals. They are elevated because of the some of the issues in the Strait of Hormuz and some of the global supply chains. That delivers benefits to the prairies in particular, Newfoundland and Labrador. But it's not what I call in economics, not an elastic response. It's not like you can just ramp up activity. I know there's a bit of residual production that can flow through the Trans Mountain pipeline. That is at capacity. But beyond that, you're not going to see a huge avalanche of drilling activity because, frankly, pipelines are close to capacity right now. So what it does do is delivers a very positive, what I call income shock to the producing provinces that filter through households, and some of that gets spent. But then you've got the negatives in Ontario, Quebec, where it's a tax on growth, tax on and disposable income. And right now, the jury would be maybe a moderate net negative on the economy, but it's still early days, and we'll see. But in our regional forecast, where we're going to be revising down some provinces, along with our national growth, I think just based on what we're seeing, we had 1.2 earlier this year. That's probably going to be down to 0.8, 0.7 now nationally for 2026. You're going to be taking on Alberta and Saskatchewan up quite a bit, but then it's going to mean lower growth for Ontario, Quebec, and some of the Atlantic provinces.